Hello and welcome back to Finworth 340 Real Estate. Today we'll be discussing Chapter 11 and the remaining chapters for this module. So an overview first of the weeks 3 and 4 material, and then we will move on to Chapter 11. First, you should read the following material for your module over the next 2 weeks, chapters 11, 12, 13, 14, 15, 16, 17, and 24. Again, you will have a discussion due Sunday, and then the following Sunday, you'll have another discussion due along with your exam, which will open on Friday, continued through. Okay. The material in these chapters begins to cover financial valuation topics, but not in great detail. And the majority of the actual mechanics should have been covered in B Core 340, but there's some greater depth here, particularly with respect in Chapter 11 to points. Okay. So again, you should have had the mechanics for that or the calculation to do so. We won't be going over the formal calculation in Chapter 11, but at later points we may have to use calculations, which we'll do with the whiteboard feature that I have set up for this class online here. Okay, Chapter 11. The beginning of this chapter really deals with making the loans and the types of loans that we have available, and what is a mortgage from a very modern lender's perspective. So the common type of mortgage that existed up until recently was the term loans. So a term loan is just a very short-term loan in which you make interest payments but no principal payment on the loan until that loan matures. When the loan matures, you make a full payment of the original principal that was borrowed. So again, interest payments all the way through, and then a very large payment at the end that kills off the principal. They were very short-term loan periods, only 2 to 3 years, but instead of actually paying off the loan, people usually just did a borrower to Peter to pay Paul scenario, which is where they would take the money that they had, they would get a new loan, and they would take the money from that new loan and pay off the old loan. Or they would go back up to the original lender and say, would you re-extend the loan for another 3 to 5 years? And they would continue doing this until effectively they had enough money to pay down the balance of the house. Unfortunately, as we know from consumer behavior, it's not likely that they're individually going to be able to save money over time or make the conscious effort to do that to pay off the loan. So it led to people just simply getting loans over and over and over and over again and never actually paying off the balance of their house. Now, this loan program is particularly old, so houses were not that expensive relative to everyone's individual income. So you might wonder why they never paid off the balance of the house. But again, people just didn't do it. They would just hold the loan renewal again and again, often for 30 to 40 years. And this works pretty well. So long as there's enough money available in the lending market, nobody's going to say, no, we won't renew your loan, because they get to earn the interest on that. So the banks are happy to do it. But in the case where individuals don't have, or the banks don't have money, they've run out because there is a credit crunch, the markets have collapsed, and people are not putting money into bank accounts which allow them to therefore loan the money back out, we have a bit of a problem. Then individuals can't get loans, and banks often say instead of renewing the loan, they're calling the balance, which means you must pay them. And you can't go down the street to another bank to say, would you give me a loan instead so I can pay this other bank? Because they're also not willing to lend. So it becomes a problem. And in the 1930s, this helped lead to the collapse in the Great Depression. People lost their jobs as a result of the market collapse, and then they couldn't make payments on their mortgages, so they didn't make payments. In some cases, they outright defaulted, or the 2 to 3 years ran up and they couldn't get renewals because the banks wouldn't loan money, because nobody had money to deposit in the accounts, and the people who wanted to borrow the money couldn't come up with the money to actually pay the bank's interest to begin with. So lots of houses were foreclosed upon and repossessed. And you can imagine that this leads to a bit of a problem with homelessness. So when you look at pictures from the 1930s and the Great Depression, you see a lot of homeless people living in tents in Hoovervilles. And this is the cause of that, those term loans, which do not allow long-term agreements between consumers and institutions like banks, that there should be long-term payment of contracts and allow people to stay in their homes so long as they make those payments, not refuse to renew them later when there's no money to do so. So a few years later after the 1930s, and we'll discuss how the FHA helped lead to this change from short-term loans to long-term loans. Now we run under an amortized loan system. An amortized loan is one where the loan is paid off incrementally over time, typically in months. So basically, they take the principal of the loan and the interest rate, and they compute over the time period of the loan what payments would need to be made on a monthly basis to ensure that the balance goes from a high number, $200,000, to zero over time. And you should have learned this calculation in B Core 340. Most of you may have taken that with me at this point. This is, again, just a payment calculation with the loan amortizing to zero. So the key here is that unlike the term loan, where you're going to make only interest payments and then one large payment at the end, the amortized loan has an incremental principal payment. Over time, your principal payment increases as a part of your overall monthly payment, and the interest payment decreases over time as the balance outstanding of the loan declines. That's basically an amortized loan in brief. 66% of all U.S. mortgages are 30-year fixed outstanding amortized loans. So they have a fixed rate of interest and they're 30 years long, and they amortize over time. They're not interest paid and then a large payment at the end. Typically, these payments for houses in the United States are made on a monthly frequency. But again, we'll talk about in a little bit how you can make a little bit of money savings using a 26 period frequency. But for the size of the loans, we're going to have them declining over time, and the amount of the payment that is determined is set by the principal, the maturity period, and the interest that is charged on that loan. An interesting fact here is that the interest that is charged on the loan is also a function of the principal, that maturity period, credit score, and the debt ratio. So the principal and maturity help determine both the interest rate and the payment on the loan. Understand there that what I've got at the bottom is that the interest is determined by two factors which also help determine the payment. Okay? So they're not independent, the interest and the payment rate. That's what you need to understand there. They're determined by multiple covariances which are the same. All right, a budget mortgage is a simple type of lending agreement where instead of just collecting the payment on that mortgage, we're also going to collect the amount of taxes that you owe on that and any insurance payment that's going to be required to insure the mortgage. This is known as the PITI payment, P-I-T-I, which is including the principal, interest on it, the taxes, and the insurance. Okay, P-I-T-I. Now, the interest, the taxes and the insurance are going to be held in an escrow account, which is just a holding account, which we made payments on an annual basis later, much like the government withholds payments from everybody's income taxes on a bi-weekly basis or bi-monthly basis, in order to make sure that there's money there to pay the balance due, and we're not coming up to you later and saying, you owe $2,000 of mortgage payment insurance premium. Do you have it? And you go, no. So they just take it out of your, effectively your payment for the house every month to ensure that those are met, and then the property taxes don't have to be reclaimed later, which again, as we talked about, may throw the title of the deed into discrepancy as to who actually owns the title of the property if you don't pay your property taxes, which is why the bank has an interest in withholding those balances from your monthly payment and putting them into an escrow account to make sure that they are paid. Okay, balloon payments. This is a very common way of dealing with the balance of a mortgage. So you make monthly payments on an amortized mortgage, but maybe you would like to make a very large payment at the end of the mortgage. So we're going to make smaller payments for 30 years. That includes the principal and the interest. And then at the end of 30 years, we're going to make a single large payment called the balloon payment that's going to pay off the value of the mortgage. When we make that payment, the mortgage ceases to exist, but it doesn't have to. Okay? But in typical form, when you make a balloon payment, the mortgage is done. You've paid it off. We don't have to pay any more. The title, as we discussed before, depending on whether it's a deed of trust or a standard mortgage with the promissory note, is going to transfer back to the effectively now total owner who's going to have their fee simple rights. And you're going to be done totally with the mortgage. The banks will wash their hands of it and call it a day. Okay. Now, the balloon payment does not actually have to reduce the full balance of the loan outstanding. It can just reduce a portion of it. So you can make a balloon payment at the end of every year. Say if you paid a mortgage of $700 every month, at the end of the year you make an additional payment of $3,000. That will significantly reduce your interest paid into the mortgage over time because it will reduce the loan outstanding. And that reduction, depending on how early you do it, reduces the interest by a compounded effect. So if you make these large payments early, you'll end up paying far less interest. Unfortunately, most people make the balloon payment at the last payment of the mortgage to pay it off because they haven't made sufficient payments on the mortgage. Or the mortgage was structured in this way to allow the individual to have smaller payments initially so they could afford the property that they couldn't actually afford. And the assumption is maybe they will save money over time and be able to make a large payment at the end of the mortgage to finish it off. Now, often that's not the case. And in fact, in 2008, which we'll discuss a little bit later, this was used as a way of giving loans to people who could not afford them, subprime mortgages. They didn't have enough income, but they needed a house. So they structured these mortgages, they being the banks, to allow individuals to have smaller payments initially for a short time period. And then after, say, 15 years, the payments would increase. Well, there's still a gap that exists there, and after another 15 years, they would have a large balloon payment that would have to come in to pay off the remaining balance of the mortgage. Well, the assumption that people are going to get promotions and increase their income they have available to spend on the mortgage, it's a nice assumption, but it doesn't always work. And particularly from 2000 going forward, people did not get very large increases in promotions, and they didn't get large increases in pay either. So a large amount of Americans had taken out mortgages in the 1990s that had assumed a low payment and 15 years later would tick up. Well, 15 years came in 2006, 2007, 2008. The payments ticked up and people didn't have money sitting aside to allow them to pay off the balance of the mortgage. Okay? And now we are coming towards the end of another 30-year period, which we'll see when those balloon payments come due, and many people don't have the money outstanding to make those balloon payments. So even now we are facing a bit of a crisis in the balloon payments for the real estate mortgages, but people are probably, if they're smart, refinancing their properties. But a lot of mortgages were structured with this low initial payment, a tick up in payments after 15 years, and at the end of 15 years, a balloon payment to pay off the remaining balance that wasn't paid in the initial 15 years. Okay? So this is a bit of a problem. They're not very popular anymore because they lead to these sort of problems with the economy where we have recessions and people don't have sufficient income to pay off the balance. Again, also the purpose of a balloon payment mortgage, you might get a small short-term balloon payment mortgage, which will allow you to get a mortgage for 5 years. Okay? So this 5-year type of mortgage will give you income able to pay for the house for a short period of time with that incoming money. And then the hope is that you will go to another lender or spend 2 or 3 more years to get a better credit profile and go to another lender or come back to the original one, get a new loan, which will last you for 30 years. That new loan will be used to pay off the balance of the old loan in a large balloon payment. Okay? So that's what's called a bridge loan. So a bridge loan is a loan which allows borrowers to attain that short-term financing, which they can later convert into long-term financing. That's why it's called a bridge. It gets you from one side to the other over a period of time. All right. So a nice way of dealing with mortgages and getting a lower interest effect on the mortgage, basically paying less over time, that's pretty easy to do. You're not going to notice it very much. But many people don't do it anymore. It was pretty well-known financial knowledge, but it's kind of gone to the wayside. So pay attention to this. It can save you money on your mortgage. Instead of paying once a month on your mortgage, you would save significant amounts of money if you paid your mortgage every 2 weeks, bi-weekly. Okay? So instead of paying once a month, you effectively pay twice a month. The key here is that it's got to be bi-weekly, okay? Not semi-monthly. There's 2 differences there. So if we pay once every 2 weeks, we're going to pay the same half amount what we would pay every month. Okay, so if we're going to pay, let's say, $500 a month, then we would simply pay $250 every 2 weeks. This effectively will cut the balance of your mortgage significantly over time and therefore cuts the interest that you will pay. Not only will you pay off the balance earlier, say on a 30-year mortgage, if you pay bi-weekly, you'll actually end up paying the balance off in 26 years. Okay? Much earlier. Okay? And so you also end up paying less interest. If you paid monthly, for example, on this mortgage, you would pay $139,000 okay, of total payments. It's a pretty cheap house. But if we pay biweekly, we end up only paying $105,000. So we end up saving ourselves $34,000 in interest. Now, the way this happens is due to two parts. Most of it is not actually compounding. And most people think that it's compounding, but in this case, it's actually due to the 26 rather than 24 payments made a year. If you paid semi-monthly, you would make 24 payments, okay? But if you pay bi-weekly, there is actually an additional 2-week period in every year, so you end up paying 26 total payments, okay? So you end up paying more than you think, and that 26 payments ends up causing the compounding effect loss of the interest that the bank would earn on the investment, and therefore saving you money. Now, banks are wise to this. The way they deal with this is front-loading the interest on the mortgage, so you end up paying most of the interest in the beginning of the mortgage rather than the end, so they get all of their interest up ahead rather than paying off the principal. And they also charge what's called a prepayment penalty. A prepayment penalty is a penalty for paying off your mortgage early. If you pay off the mortgage early, they will charge you a fee for doing that, and that is to ensure that they at least get some of the interest that they were expecting to get and reduce any losses from people being prudent, financially savvy individuals and paying things off early because they're greedy bankers. So that's just how it works. Okay, points are a pretty difficult part of mortgages, especially the calculation on them tends to mess up students quite a bit. And they're hard to remember how the calculation works, so that's to be expected. But a point is just a 1% balance of the loan that is outstanding. So a 1% or 1 point balance on an $80,000 loan is $800. A 3 point on an $80,000 loan is therefore $2,400. And there are two ways that points come into play with respect to finance in the real estate realm: with origination fees and adjusting the effective yield of a mortgage. So the origination fees, let's go on to that next. It's pretty easy. Basically, banks have to incur cost in order to originate the mortgage, which means to give you the mortgage. They've got to pay the loan officer who's going to do all the reviewing of the budgets and your credit profile. We've got to pay them a salary. There's overhead for the bank. It's a building. They've got to pay for that. There are costs in obtaining the credit reports, okay, et cetera, et cetera, et cetera. All of these costs. And they may be line itemed and written down in a list for you and told, oh, you need to pay $1,500 in origination fees. Or the bank may forego giving you a line item of what exactly they're charging you because they don't really want you to know how much they're paying people or the overhead is or the cost of the credit reports. People tend to be a little upset that they have to pay for the loan officer's salary. They argue, well, that should just come out of the bank's overhead. The bank is generally passing these on directly to you, and they don't want individuals to know explicitly that they're paying for bank overhead. It's not very good PR. People tend not to like it. So instead what they do is charge an origination fee as a point on the mortgage as a flat rate. So of course in the background they've already calculated that they need to charge XYZ% of a mortgage in order to make balance of what their overhead and officer salaries are going to cost them. But instead of telling you an itemized list, they just say, this is how much we're going to charge points per mortgage in order to make up all of our costs as a flat rate. And they charge this to everyone. So they say any loan that we, Bank ABC, are going to originate is going to get a 2-point fee for origination. Okay. So the loan also may be stated 3 points on the mortgage balance for origination. And if it's a, let's say, $100,000 mortgage, then you would be paying $3,000 in origination fees. And that's where they get you. Origination fees are extremely high. Notice I just said $100,000 mortgage. Even in the Morgantown area, most houses outside of, say, South Park and some other areas, perhaps Westover, are running $200,000 to $300,000. The market is pretty pricey. So on a $300,000 mortgage, if you're paying a 3-point mortgage origination fee, you're going to be paying $9,000 simply to get that mortgage. And that is not money you get back anywhere. You can't pay off the mortgage early and earn equity on it. Okay, that is just a fee. So you lose that money. If you actually go through and calculate the origination fees as a percentage of the effective mortgage yield with the interest rate you're paying, it raises the interest rate by almost 1% to 2%. Okay, so be very careful when you're reading origination fees. Ask them to document it if you can, and try not to pay a point. Because if you pay a point, it's almost always going to be more than if you had paid an itemized origination fee list. The other way that points can be used is to discount interest rates on the mortgage. So if you get an offer for a mortgage, they may say, if you pay us 2 points on a mortgage, we will lower your interest rate by 0.25% per point. Okay? So the way this works is that they're going to lower the interest rate provided you pay them an upfront fee. Give us some money initially, we'll lower this interest rate. And this tends to sound nice because you might think, well, if I pay 0.5% less interest per year for 30 years, then I'm probably going to save a lot more than $2,000 to $3,000. But that's not always the case. So you need to do the calculation to figure out if you would end up actually saving money on this transaction by accepting the discount points rather than not paying for the points. So take, for example, a $150,000 mortgage offer with point discounts for 3 points, and they will lower the mortgage by 0.5% on a 5% mortgage that's 30 years. So first we need to figure out what will the payment be on this mortgage, and then we need to figure out, working backwards, what's the interest rate using that payment that we are effectively actually getting. So first step here, and you should know how to do this from BCOR 340 rather, we're simply calculating the payment on a loan. So we're taking the balance of $150,000, the new effective interest rate, we said we have 5% originally, but they're going to lower it by 0.5%. So the new effective interest rate is 4.5%. And that's going to be computed monthly, so we've got 4.5% divided by 12 there. It's a 30-year mortgage, again monthly, so we've got 360 months. So the payment that we're going to compute here is the payment that would take $150,000 down to zero over 30 years at 4.5% computed monthly. And that turns out to be $760.03 a month. Now, we reuse this payment that we computed here on the mortgage, but we take out the amount of points that we're going to pay up front from the original balance of the mortgage. So the new present value that we have is $150,000 minus the $4,500. So again, there's 3 points. That's 3% of $150,000. That's $4,500. So take the $150,000 minus the $4,500, and you get $145,500. That new balance is what is used in the present value to compute the effective rate on this mortgage. So we're going to use rate calculation in Excel, for example, and put the $450,000 as the new balance. Use 360 still, since we're still doing 30 years for 12 months. And we're going to use the original payment we computed at $760 and compute the actual interest that we will be paying. Now, when you use the rate function, as you will recall from BCOR 340, that is going to give you a monthly interest rate. So there we've got multiply by 12 to get us up to the effective annual interest rate, non-compounded. Simple interest rate there, okay, not compounded. And it comes to 4.82%. Now that 4.82% is higher than the 4.5%. So we are paying more than the 4.5% would lead on, but it is lower than the 5% we were originally quoted. So by taking this deal, we are saving money. However, that's not always the case. In some cases, depending on the interest rate and the balance of the mortgage, you may end up paying more money. The effective yield is higher than the original rate quoted. And you wouldn't know that unless you actually sat here and did the calculation. The bank is under no obligation to tell you that. So they will offer these points to you in the hopes that you will take them, on many cases knowing full well that you're going to end up paying more for the mortgage than had you not taken them. Okay? So you need to do the calculation. And if you're going to go into real estate, you need to advise your clients to do this calculation or do the calculation for them to make sure that taking the points will save them money. Okay, now there are two major housing programs in the United States which don't really cover a large amount of the mortgage, but they're the largest housing programs we've got. They used to, in the case of the FHA, cover a large portion of the percentage of mortgages that were originated in the United States, but no longer do so. The FHA now only covers, I think it's 12, as your book says, 12% of the mortgages currently originated in the United States, which is a very small portion. So due to the collapse in the 1930s, the federal government needed a way of spurring construction, and they did this in multiple ways. For example, the Congress created the Civil Corps, which basically had soldiers coming back who had not gone yet to the war or coming back from the fights in constructing new roads. Okay, so they built highways and lots of new construction. So all of the highways today were built during this time, and it was just a large outflow of government funds in order to spur economic production, because these construction workers were in fact paid. And we had to buy concrete, which was paid to the industrial sites, who then paid their workers. So it helped spur the economy. And this is the Keynesian view of what the government should do to counterbalance recessions. So they also created the Federal Housing Administration under the National Housing Act. And what this did was to allow an administration, part of the government, to insure banks against the risk of defaults on mortgages. So again, banks didn't want to lend to people in the 1930s and 40s. So this FHA agreed to insure the banks against losses, provided they would do the mortgage, they would do the lending. And also the FHA would go in and actually monitor these loans. So they would come to the borrower and they'd say, all right, you want to get a loan? You need to give us your budget. How much can you afford? We're going to check your credit, make sure you're not defaulting on anything else or you don't have too many other loans outstanding. And they would also inspect the property, which was a pretty big deal. It's very important that you know that the property has actual good value before you provide a mortgage on it, because if the property is just simply overvalued, then it's not it may lose that value and the mortgage may be over under at that time. And the bank's not going to be able to collect on that value if they try to sell the house later. Okay, so they performed these monitoring of houses and real estate and loans that the banks didn't have to do, which helped keep origination costs fairly cheap at the time. And you can imagine that by insuring the mortgages and keeping origination costs pretty low, banks were much more willing to loan, and it worked. Not only were they willing to loan in the buying of homes, they were willing to loan in the construction of new homes, which again leads to construction-based economic growth, which is a very strong means of growth. It's the way that the economies of basically the world regrew after the devastation of World War I under the Keynesian model. Okay, and then later you get World War II, which destroys things, and Keynes comes back again, and we get new Keynesian philosophy as well, which again focuses around rebuilding. Okay, so the FHA has a very large part in the reconstruction of America. They were very good at their jobs. They charge a certain amount of fee on the mortgage to the individual, a 1.5% of the loan, and they also charge the banks. So they serve as an intermediary between the individuals and the loan, charging both the institutional bankers and the individual premiums on their mortgage and to monitor the loans. And they were so successful at this, they ended up producing profit and returned that back to the United States Treasury. And as a response, in 1946, Congress made them a permanent fixture of the U.S. government rather than a temporary fix to the economic recession of the time. So again, they charge an upfront fee of the mortgage of 1.5% of the loan value, and then an additional 0.5% of the loan balance on an annual basis. Now, they separate that as monthly and make it part of the monthly home payment, but it still exists. That 1.5% is effectively private mortgage insurance. So that is simply insurance that allows them to pay for a mortgage should it go to default. Once the home reaches 22% of equity in the home value, so that means if your house is worth $100,000 and you've made sufficient payments on the mortgage that you now own $22,000 worth of your house, that 0.5% of the loan balance is no longer charged. The PMI falls away. So again, once sufficient payments have been made, FHA no longer charges the 0.5%, but you can never get back that 1.5% of the home value. Okay, but the nicety of this is that the FHA will continue to insure the property from the bank's perspective, even if they no longer charge that 0.5% on an annual basis. The other institution that exists is the VA. Okay, so the Department of Veteran Affairs, was created by the GI Bill of Rights that was enacted after World War II, and we had a lot of troops coming back, and we wanted to get them homes. So the easiest way to get them homes, and these workers, or the soldiers had been away for so long, they didn't have great workers' skills, and they had to be reacclimated to society. So we need to get them jobs, and in order to sustain a job, you need a place to live, and we weren't going to create barracks for them. We also needed to spur population boom at this time. A lot of people had been killed. So the best way to do that from the government's perspective is to get these gentlemen married and get them a house. It tends to be the case that when you have a house, you create a family. So we provided them no down payment required because they didn't have a lot of money. We provided them loan guarantees, much like the FHA. And these were 30-year long-term fixed-rate mortgages with no prepayment penalty, and then a 1-point limit on the origination fee. So a pretty nice deal, and this deal still exists today for members of the armed forces who have served in... Oops, excuse me. Okay. Sorry about that. This is where you get telemarketers. So we have the service of these loans here, and it's a pretty nice deal. 1-point origination fee on that. And so basically this will get them a house. Okay, they don't have a lot of money, so we can get them into a house. We can guarantee that mortgage at a 30-year long-term period. And you can still get this today if you're a member of the armed forces, provided I believe you have to serve 6 months of time active duty or have served in one of the armed conflicts that was formally declared by Congress. So Congress actually has to declare war, or you have to be an active duty member for 181 days in order to be considered for veterans benefits under the GI Bill. And once you do that, you get access to all of these perks. So they're pretty nice. If you are a member of the Veterans Agency, you need to contact the Veterans Affairs and see what you have available to you. Okay, private mortgage insurance was created in the 1957s from the Mortgage Guarantee Insurance Corporation. MGIC is what it's often called. And their entire purpose was to offer private mortgage insurance to individuals who were not qualifying under the FHA program. So they were going to insure banks against the default of a mortgage, and this allowed bankers to go to offering effectively 90 to 95% loan to value. So basically the individual would have to put at 5 to 10% in a down payment, and the bank would offer 90 to 95% of the equity in the home as a loan to the individual. Instead, but they would be taking on effectively only 70 to 75% exposure to the loan, provided the individual had private mortgage insurance, because MGIC would provide 20 to 25% of the mortgage balance in insurance. So they would insure the bank against loss of 20 to 25% of the money that they provided. This is a pretty good deal. And it led to a large growth of the non-FHA loaning industry. So this is a private solution to, or free market solution as you might call it, to the government FHA program, which is not a free market solution. And today has taken over predominantly the greater market. So as I said, FHA only controls 12% of mortgages outstanding, and VA I think is 6 or 8%. I don't remember the top number off the top of my head. So the majority of mortgages are under PMI if they need it. Again, you only get the PMI, the private mortgage insurance, if you will put a down payment less than 20%. So you drop lower than 20% of the mortgage, then you must get PMI, or the banks don't want to lend to you. But this allows people who do not have sufficient capital to get homes. So homes today, as we just said, $300,000. If you need to buy a house and put 20% down, you need $60,000 of cash. That is often a very large amount of money for people coming out of college in particular. So you're in your early 20s, 22, 23 years old. Many of those individuals don't have $60,000 of cash sitting around. And today, most people in their 30s, maybe even their 40s, don't have $60,000 of cash sitting around. So this PMI insurance deal allows people to get access to loans, okay, at 5% on a $300,000 mortgage is only $15,000. That is a much easier bar to reach, okay, than $60,000. And people can generally afford that. So this allows people to get into homes. Now, after people have again made so many payments, there was a law passed in 2000 that made it so that you, after you reach 20% of equity in your home, the private mortgage insurance is automatically extinguished, so you don't have to continue paying the premium. So much like an FHA. Okay, at 20%, you can ask the lender to extinguish the loan. At 22%, it is statutorily, legally required that the mortgage insurance company who's providing your mortgage insurance has to extinguish the insurance policy, and you no longer collect on that mortgage. Okay, that covers the material for Chapter 11. Chapter 12 is next, is the consumer and loan. Discusses basically how consumers have to act with respect to banks and how banks have to react with respect to consumers, and the laws therein that protect consumers' rights in fair lending.